Hi there. Welcome back to AI Investor Talk. The effects of money supply require examining the nuances of how changes in the money supply interact with various aspects of the economy. This includes understanding the mechanisms through which money supply affects inflation, interest rates, exchange rates, and broader economic activity. Let's explore these areas in greater detail. 1. Mechanisms of money supply and inflation. The quantity theory of money provides a simple framework to understand the relationship between money supply and inflation. It is often expressed as MV equals PY. M stands for money supply. V is the velocity of money, which is the rate at which money circulates in the economy. P represents the price level, and Y is real output or real GDP. According to this theory, if the velocity of money and real output are stable, an increase in the money supply directly leads to a proportional increase in the price level, resulting in inflation. However, this relationship is more complex in reality because both V and Y can fluctuate. In the short run, an increase in the money supply can stimulate economic activity without immediately causing inflation if there is underutilized capacity in the economy, such as high unemployment. However, in the long run, once the economy reaches full capacity, continued increases in money supply tend to fuel inflation. Demand pull inflation occurs when an increased money supply boosts overall demand in the economy faster than the supply of goods and services, leading to higher prices. Cost push. Inflation, while not directly related to money supply, is worth noting. If money supply increases lead to higher wages or input costs, this can cause cost push inflation, where businesses raise prices to cover the increased costs. 2. Interest rates and the money supply. The monetary policy transmission mechanism is how central banks typically influence the money supply through open market operations, adjusting reserve requirements, and setting the discount rate. Open market operations involve the central bank buying or selling government securities to adjust the amount of money circulating in the economy. Buying securities increases the money supply, lowering interest rates, while selling them reduces the money supply, raising rates. Reserve requirements refer to the fraction of deposits banks must hold in reserve. By changing the reserve ratio, central banks can directly influence how much money banks can lend out, thus affecting the money supply. The discount rate is the rate at which commercial banks can borrow from the central bank. Lowering this rate encourages borrowing, increasing the money supply, while raising it does the opposite. The liquidity preference framework, introduced by Keynes, suggests that interest rates are determined by the supply and demand for money. When the central bank increases the money supply, it shifts the supply curve rightward, leading to lower interest rates, assuming the demand for money remains constant. 3. Exchange rates and money supply. The impact on currency value is significant. When a central bank increases the money supply, it can lead to a depreciation of the national currency. This occurs because lower interest rates, resulting from an increased money supply, reduce the returns on domestic assets, making them less attractive to foreign investors, leading to a lower demand for the currency. Beggar thy neighbor policies refer to countries intentionally devaluing their currency by increasing the money supply to boost exports. However, such competitive devaluation can lead to retaliatory actions from other countries, sparking trade tensions or currency wars. Capital flows are also influenced by changes in the money supply. For example, a loose monetary policy might lead to outflows of capital as investors seek higher returns elsewhere, while a tight policy might attract capital inflows. Asset bubbles. Rapid increases in the money supply, particularly when interest rates are low, can lead to asset bubbles. Investors might borrow cheaply to buy assets like real estate, stocks, or commodities, driving prices up beyond their intrinsic value. When the bubble bursts, it can lead to significant economic disruptions. Wealth effects. An increase in asset prices, spurred by an expanding money supply, can create a wealth effect, where individuals feel wealthier and thus spend more. This can further stimulate economic activity but also risk fueling inflation if demand outstrips supply. Variability in velocity. The velocity of money can change based on economic conditions. For example, during a recession, people might hold on to money longer, reducing velocity. Conversely, in a booming economy, the velocity might increase. Central banks must consider these shifts when managing the money supply, as a stable velocity is rare in the real world. Role in hyperinflation. In extreme cases, such as during hyperinflation, the velocity of money can increase rapidly as people spend money as quickly as possible to avoid holding depreciating currency, exacerbating inflation. Financial stability considerations are crucial when evaluating monetary policy. Changes in the money supply can influence credit cycles. An expansionary monetary policy can lead to excessive borrowing and lending, increasing the risk of financial instability if borrowers are unable to repay loans. Prolonged periods of low interest rates driven by an increased money supply might lead to moral hazard, where investors and financial institutions take on excessive risk, expecting that central banks will intervene to stabilize markets if things go wrong. An overly loose monetary policy might sow the seeds of financial crises by encouraging excessive risk-taking, while a sudden tightening of policy can trigger a credit crunch, exacerbating economic downturns. Expectations and the role of central bank communication are essential in shaping economic outcomes. According to the rational expectations theory, if economic agents anticipate that an increase in the money supply will lead to inflation, they may adjust their behavior, for example, demanding higher wages or raising prices, in ways that can make inflation a self-fulfilling prophecy. The effectiveness of monetary policy is heavily dependent on the credibility of the central bank. If the public trusts that the central bank will maintain price stability, the adverse effects of money supply changes on inflation expectations might be mitigated. However, if the central bank loses credibility, even small changes in the money supply can lead to large swings in inflation expectations. Central banks use forward guidance to manage expectations by communicating future policy intentions. Clear guidance can influence economic behavior even before any changes to the money supply occur. Global implications of changes in the money supply are significant. Spillover effects occur when changes in the money supply in one country, especially a major economy like the United States, can have global repercussions. For example, an increase in the US money supply might lead to capital outflows from emerging markets, causing their currencies to depreciate and their inflation to rise. Given these spillovers, international coordination of monetary policy can be important to avoid negative global consequences, such as competitive devaluations or capital flow volatility. In summary, the effects of money supply are complex and interwoven with various facets of the economy. Central banks must navigate these intricacies carefully to promote economic stability and growth, while minimizing the risks of inflation, asset bubbles, and financial instability. Understanding these deeper dynamics is crucial for grasping how monetary policy shapes economic outcomes over both the short and long term. Thank you for watching. Please like and subscribe. Make the background music professional.